Now, continuing with the topic of these custodian agreements, our own audience is familiar with my frequent attacks on the legitimacy of the so-called bullion ETFs like GLD and SLV, where these same bullion banks claim to be storing massive quantities of gold and silver bullion on behalf of millions of retail investors. Given what we now know about the leverage in this sector, do you think there is any way that these bullion banks could fully back both the ETF custodian agreements and their own gigantic short positions?
No, I mean, the famous bullion ETFs, if you read their prospectuses, the prospectus doesn't say categorically that they're going to be 100% backed. And if we've learned anything in the last 2 years out of the financial crisis, you cannot expect anybody in the Wall Street world to be doing more than what they promise their prospectus. That just doesn't happen, and what we've seen is that they tend to do less. So if it's not watertight in a prospectus that the ETF is going to be 100% backed, I think anybody would be foolish to believe that it is. The major ETFs of GLD and SLV, the custodians are the two bullion banks, HSBC and JP Morgan Chase, that GATA has accused of being the major shorts on the COMEX. They are certainly the biggest holders of gold and silver derivatives on the OTC market. That is quite clear because that is reported to the OCC, so their names are reported in a public document. These guys are mega short, and they are the custodians of a stash of bullion. That would seem to me like a rather large conflict of interest, and that has not been declared in the prospectus, which is against securities law for that to be not in the prospectus. That should be a material fact that is given to investors of these ETFs.
Well, that's something that's always floored me about the business model for these funds is, like you say, the inherent conflict of interest that we have this idea that the largest shorts in the bullion market would be sponsoring the entry of millions of long investors at essentially zero profit to themselves. It just doesn't pass the smell test.
No, it definitely sounds like the fox guarding the hen house, doesn't it?
So then basically you would look at a GLD unit holder as being in pretty much the same boat as the holder of an unallocated gold account.
Yes, yes. I mean, and it's not just me with that sentiment, because if you look at David Einhorn, whose fund Greenlight Capital had $500 million in GLD, and last year famously switched that investment to holding real physical bullion. If he considered that it was equivalent to bullion, there would be no logical reason for making that switch, because I'm sure it's a lot more convenient to have GLD share certificates in a filing cabinet than having to arrange to store $500 million of physical gold and insure it and look after it. So that's a fairly large vote of no confidence that Greenlight Capital made. And as I say, if you look through the prospectus, you really can't get a warm fuzzy feeling that this ETF is 100% backed. And it's not rocket science. It's not difficult to say for every share that we sell, the share will be backed by 100% bullion, which will be unencumbered and held in our vaults, and can be audited by a third party, and will make the audit public. I mean, that's what I've said is one paragraph. It's not difficult to get a lawyer to draft that up for you, to make it unequivocal that this ETF is fully backed. And there are ETFs out there that do that, such as CEF or GTU. They make it unequivocal that they are backing their ETF 100% with bullion, and it's unencumbered, and it's not diluted in any way when they issue more shares. They buy more metal, and it's audited. It's not difficult. If you really want to do that and have a a vehicle which everybody can trust and have confidence that it's doing what it's meant to be doing, it's very easy to draft the agreement, the prospectus.
And then those smaller funds charge higher management fees because, of course, it costs a lot more to store metal than it does to store paper.
Yes.
Now let's turn to some more general subjects here. Your own website, Market Force Analysis, described itself as a revolutionary technique for analyzing and forecasting the trends in futures markets. Without giving away any secrets, could you explain to our audience in a little more detail what your site provides to investors?
Yes. What we do is we provide a report every 2 weeks, which determines what is the near-term trend in the market, which is the next 15 days, and what is the longer-term trend in the market. And this is particularly useful, obviously, for determining good buy and sell points. We have filed 2 patents on our technique. What we essentially do is extract from futures markets data supply and demand. And the difference between the supply and demand is what we call force, which is why it's called market force analysis. And that's what determines price, and what determines the trend in that force determines what is the near-term and longer-term outlooks. So, it's really coming down to the core of economics. Economics tells us that supply and demand determines price, and that's what we try to do with this technique.
So this is not, sorry.
And
so this is
the standard technical analysis uses price, but price is the result of the supply and demand imbalance. So what we're doing is looking at the supply and demand imbalance to determine price, rather than trying to look at price and try and determine what price is going to do. It's a kind of circular thing, isn't it, really, if you look at price and try and determine what price is going to do.
Now, is this an analytical technique which is only applicable to commodities markets, or could be more broadly applicable to other sectors as well?
It's only applicable to the futures market model, where you have a balanced number of longs and shorts. So it wouldn't be applicable to stock market, for example. So It's unique in the futures market, where for every buyer you've got a seller, every long you've got a short. It would work also for option markets, but the volume tends to be too small in most option markets, that we get far too much noise. So essentially it's a product we apply to the futures market. And we specialize particularly in gold and silver. That's our premier service.
Well, I'm sure many members of our audience will be interested in looking at that in greater detail. Now, I came across an older YouTube video of an interview you had done. I'm sorry, but the source wasn't identified. You were talking mostly about silver. You came out with an amazing quote where you were referring to data from the U.S. Geological Society. And you concluded that silver will be the first element in the periodic table to become extinct. And then based on that data from the U.S. Geological Society, you were estimating that this could occur as early as 2020. Would you like to add some additional remarks to that observation?
Yes. The estimated economic resources that in silver left to be mined is around 7.5 billion ounces. And so at current production rates, that's about 10 years. And so the USGS didn't say specifically that we will exhaust silver in 10 years, but that was my deduction from their data. Now, of course, you could argue that they also report resources which are not economic at the moment, and as the supplies run out, perhaps some of those resources will be economic, but that's not necessarily certain, because, for example, there's 12 million ounces of gold in seawater, but I don't think it really matters what the price of gold will be. I don't think it will ever be economic to extract 12 million ounces of gold from all the oceans on the planet. So some of those resources will be economic. But what I wanted to emphasize by that, I tried to be a little bit provocative in that statement, was to make people aware of the fact that the suppression of prices of precious metals is a